For the APV approach, rather than rewrite the whole thing out, I'm going to tell you what you do conceptually. And then it's just a matter of taking the same present values. So the first thing we do that is different. So the forecast is the same. And terminal value is the same as you did before. Okay. Now what's different is now the discount rate is, I'll write KE, cost of equity. Now how do we calculate cost of equity? Normally we will be given WACC, and we're going to use this formula here. WACC is the portion which you would have seen from the previous chapters. The portion you have in equity as a part of the company times the cost of equity, plus the portion you have in debt times the cost of debt. I should stick with the same terminology, KD, times 1 minus the tax rate. Okay. So usually what you will be given is you will be given all of this information. You'll be given, you won't be given that. You'll be given the cost of capital, the portion you have in each, and then you will have to calculate this. And remember, this is levered. So you may end up using this formula here from case 2 of M&M. And the formula is that the cost of levered equity is equal to the cost of unlevered equity plus cost of unlevered equity minus the cost of debt times the debt to equity ratio times 1 minus the tax rate. Okay. And if you do that, then essentially what you've done is you've calculated this cost of equity that you're going to use as your discount rate. So everything stays the same forecast, discount it back using this cost of equity, the levered equity, and then the terminal value, discount that back using the cost of levered equity as well. And the other difference is you're going to add the present value of all tax saved on interest. And if it's given on an annual amount during the forecast, it should be straightforward to do. It's essentially, for example, let's just do a simple calculation, year 1, year 2, year 3. I'll keep it straightforward. If I was to say 10% is your interest, and I'm going to say tax is 30%, then you have savings of $3 of interest, or $3 of taxes each year. And what you would do is you would take the present value using cost of debt as the discount rate. And at that point, you've essentially got what you need for your adjusted present value. So let me write all of that out. So your APV is going to be PV of the free cash flow. And I'll write here at, or using WACC as a discount, plus PV of the terminal value, and again using WACC, and then plus the PV of tax saved on interest. And in this case, we would use cost of debt as a discount rate. Okay, so at that point, this will all give you the enterprise value. And then you can further break that down into equity and debt if you are using that to calculate the share price, just like we did for the DCF approach.